Manishi Raychaudhuri, Asia Pacific Equity Strategist at BNP Paribas Securities, now joins us. Manishi, hi, good morning. Sitting in Hong Kong now and talking to a lot of FIIs on a regular basis, what's the feedback on this budget? How do you think FIIs are going to react to this budget? Because there's been a lot which has been done for them.
There were a lot of expectations built up about this budget. The so-called Big Bang reforms that some people had been talking about, though one struggles to think what those Big Bang reforms could have been. The budget actually avoided making any of those so-called Big Bang announcements, but they actually laid a clear foundation for growth and, a long-term architecture going forward. So to that extent, I think this relaxation of the fiscal deficit target from 3.6% to 3.9% was relevant because that was actually neutralized by a much higher degree of planned investment in infrastructure, which I think would be supportive of growth. And also among the FII investors, this plan to reduce the corporate tax gradually from 30% to 25% would go down well, even though it's not supporting right now, not from next year, but from fiscal 17 onwards. I think the FIIs would also anticipate, or rather appreciate, the stability in the tax regime, that is laying down a clear roadmap for corporate tax, and the reduction or a gradual extinguishing of the exemptions that were being given, and more so the postponement of GAR by 2 years and clarification of some of the GAR provisions that's been made in this budget. So those are clearly the positive signs from the perspective of an FII. Where some doubts could creep in are possibly some parts of the fiscal arithmetic, like the food subsidy that's been slated to increase only 1.4%, but if you look at last 5 years or so, it has historically increased about 19 to 20%. So, there could be some questions raised on that. Secondly, on the divestment target of 695 billion, there were similar aggressive estimates being put into the fiscal arithmetic by the government over the last couple of years, but none of these were actually, satisfied or achieved by the end of the year. So I think that could be another point of doubt, whether the fiscal arithmetic is correct or not, and therefore, there could be some doubts as to how the Reserve Bank of India could be aggressive in terms of reducing rates in the remaining year. So I think, this is really a long-term plan which the FIIs would appreciate. In the very near term, there could be some correction in the market because not only there is the phenomenon of, what investors tend to call buy on rumor and sell on news, but also because the competing markets in Asia and the emerging market universe are doing lots of stuff, particularly in monetary policy easing to attract flows. China reduced interest rates. The PBOC cut interest rates by 25 basis points on Saturday, which could lead to some degree of gravitating of the fund flows into the North Asian markets in the near term. Having said that, I think from the FII's perspective, India remains one of the safer and one of the best markets in terms of stock selection, and that advantage is unlikely to go away in the near term.
Okay, Manishi, I like your frankness because just a while back I was saying that I'm not seeing any negative voice. So the first sell-side strategist saying that the markets will correct now. How much correction do you envisage, and at what point will the market be a screaming buy again?
Well, I don't think the correction would be severe. Historically, if you look at last 10 years or so, on most occasions the market has corrected post-budget because of the same trading-related phenomena that I talked about. But at the same time, I don't think it'll be more than, anywhere between 4 to 5%. The important point is that if the market itself corrects about 4 to 5%, the high beta stocks would possibly slightly correct a little more. And that, I think, would be used by the FIIs as a buying opportunity in private sector banks, in consumer discretionaries, in select industrials and capital goods stocks, particularly those which are not over-leveraged at this point of time. And maybe even in IT services, even though that has got nothing to do with the Indian economy or the Indian budget and it's more globally linked. but it is very clearly turning out to be one of the favorite sectors of the FIIs in the medium term.
Okay. Manishi, could consumption, according to you, slow down in the near term because of either higher service tax or increased petrol and diesel prices?
Well, it may happen in the very near term, but over the longer term, I think this moderation in commodity prices would actually lead to, disposable incomes going higher. If you look at commodity prices, for example, oil, they have almost halved over the last 6 to 7 months, notwithstanding this recent rally that we have seen over the last 3 to 4 weeks. A majority of that benefit has been retained by governments. And this is not just in India, but all across Asia. Even Korea has raised, taxes on fuel. But we think that at some point of time, maybe in the second half of the year, the governments would gradually begin to pass over this benefit to the consumers. So, I think, notwithstanding this very near-term headwind that consumption may face, I'm not really very negative on consumers, particularly on the consumer discretionaries. And, this decline in commodity prices in general, that's also leading to core inflation coming down quite rapidly, which would obviously be favorable for the consumption environment in general.
Okay. Manishi, do you think the possibility of a rate cut goes down now that the government is, shaking a little bit from its fiscal deficit target?
As far as the rate cut is concerned, we would think that it may not happen ahead of policy. In fact, our point of view is that in the remaining part of this year, we are likely to see possibly about 50 basis points of rate cut. So it may happen in the next policy, and possibly another episode could come in the second half of this year. So this is a relatively modest and moderate rate cut or rate decline trajectory that we're talking about compared to many other economists or many of our peers. And to some extent, I think that, kind of entwines into what you said just now. There are some lingering doubts about the fiscal arithmetic, though I don't think they are a big concern this year, because this year I think the assumptions made in the budget are far less egregious than had been made in the previous few budgets. So there is a strong possibility of the budgetary arithmetic actually being achieved this year. The only points of concern that still remain with us are possibly the subsidy arithmetic and the disinvestment target.
Okay, so let's talk about some of the stocks, Manishi, which have been active. Right on top, of course, private sector banks. They corrected significant in February, but will the budget be a catalyst for them to take leadership back? They've shown signs of that in the last couple of days.
See, this budget is obviously unequivocally positive for a couple of sectors like capital goods, engineering, industrials, and by implication also for the banks. Because this whole relaxation of fiscal deficit that he has done from 3.6% to 3.9%, that has almost entirely flown into targeted higher infrastructure spending. So there is additional 700 billion rupees allocated to that, which is almost a 20 to 25% increase in the capex target, and this is particularly concentrated in roads, urban transports, shipping and ports, etc. And by implication, obviously, the increased investments and consequently the loan that is generated for that would be beneficial for the banks, particularly those which have a relatively low loan-to-deposit ratio and which don't have a massive need for capital raising. So that automatically brings us to the private sector banks, because for the public sector banks, that advantage is not there yet. They are still in need of huge degree of capital raising. So that, I think, is the fundamental framework why private sector banks in general moved up on Saturday, and we retain our long-term positive outlook on the private sector banks. I think this FDI and FPI, the foreign direct investment and foreign portfolio investment, combining these two, that is obviously beneficial for some of the private sector banks like Axis Bank or Yes Bank, where a significant degree of FII window or headroom is opened up. So I think that's kind of an icing in the cake, but I think the fundamental factors are also important.
All right, the market, by the way, is now at the low point of the day. The Sensex is in the red, the Nifty is almost there, and the mid-cap index has also slipped from the highs. And yet again, the biggest culprit remains ITC, and Tata Motors is now joining in. Reliance is down about 1%, Infosys and TCS are down. So all these stocks are leading to this intraday slip. As you can see, Tata Motors now trading at low point of the day, and I think the other big drag really has come from Reliance and ICICI Bank. If you see the intraday chart of both these stocks, it's seen quite a bit of decline. Reliance is now trading at low point of the day, down 9 rupees, and ICICI Bank is now also trading in the red. But the biggest drag still remains ITC. Manishi, the excise duty hike was significantly high. Do you think the stock will derate further from here? I mean, it's already down 11% in 2 days.
Well, I think for for ITC in particular, there could be some earnings downgrades. See, historically, ITC has been a stock where any of these administered price increases, excise duty, etc., they have traditionally been passed on to the consumers, while ITC still maintains its its market share at about 65 to 70%. Over the last couple of years, we're noticing some degree of decline in the volume growth that ITC has been reporting. So it would remain to be seen whether the extent of price increase across the product segments they're able to pass on in its entirety to the consumers or not. So there could be some consensus earnings downgrades for ITC, but at the same time, ITC is one of the companies in India which has tremendous pricing power. It is one of the best managed companies. So, I think if we do see some more correction in the stock, that would actually provide some buying opportunity for the longer term investors here.
Okay, Manishi, let's get back to the markets now. Can you tell us what your Sensex and Nifty targets are, and will you tweak them?
Our year-end Sensex target is 33,200, and I'm not making any change to those targets right now. They actually factor in, somewhere around 16 to 16.3 times PE multiple, which is slightly higher than the longer-term average of about 15 times. I think, in this budget, even though there is a clear roadmap that's been laid for growth, to argue for a multiple expansion from the present levels would be slightly presumptuous, and particularly because some of the North Asian markets could also garner some of the flows which India has been almost unequivocally getting over the last few months. As a consequence, I think the current expectation that we have, which is close to about 15% upside for the Indian market, is fair. It is approximately in line with the earnings growth that the market is likely to exhibit. In fact, fiscal 16 and 17, we have mid-teens kind of growth, about 15 to 17%. And, I would possibly stick to those targets for the time being.
All right, Manishi, thanks a lot for your time today. That's the call from BNP Paribas Securities. But